the 1 month lease rate, which reflects the cost of borrowing the metal, which is, I think, a true market indicator of shortage and availability of the bars. It dropped the lease rate for 1 day down to 4%, and then it spiked right back up again now to the 12% range, and it's holding. Right. So it's very interesting, Chris, to see this, rising prices and yet continual indicators of lack of availability of the metal to market. And I think this is really a consequence of the pricing of these metals with paper in London.
Hello there, my friends. Chris Marcus here with you for Arcadia Economics. And today, fortunate to have David Jensen back on the show because with Palladium spiking recently, I think David is far ahead of the curve. I don't know anyone else who was warning about this. We've been talking about it for a year. I know he's been digging in further than that. So it's a pleasure to have him join us and dig into it. Before we get started, go ahead and hit that subscribe button and also the notification bell right down there so that you can stay posted and know when episodes like this are released, as I do genuinely want to bring you the best information possible as soon as possible so you can hear folks like David who warn about these things far before Wall Street even can figure out how to spell palladium or platinum, let alone gold or silver. So with that said, David Jensen, who runs a metal and mining advisory services for Jensen Strategic, also found at Real David Jensen, Jensen on Twitter. So long intro done and complete. David, how are you, sir?
I'm well. How are you doing, Chris?
Good, and wishing I had more palladium and rhodium in my pockets, but again, fortunately, you're on the show to help break that down for the audience, which I'd like to commend you. It really is impressive how you've been so far ahead of the curve on that. And perhaps just to get started, you've seen the price rise, and when you and I caught up in Vancouver a few weeks ago, I thought you put it into good perspective when you mentioned how what's interesting is that the price has risen, yet the lease rates have also stayed high, which indicates that, normally in a market, the price rises or goes down in other situations. It solves an imbalance. But you were saying that the high lease rate shows that the problem is still there. Are we running out of metal? And just maybe a quick overview before we dig into some of the charts you have.
Yeah. If we look at Palladium back in 2008 to 2010 timeframe, it had started to rise up, and I think it hit around 550 of that order before the great financial crisis happened, and then it collapsed down to, I think there was an intraday low of about $150 an ounce. And what's been interesting is that ever since that date, the price has it risen really materially. It rose to about 900 within a couple of years, which in and of itself was quite a spectacular run at the time through to about 2010. And the problem is, though, that the platinum price fell from 2010 forward. And palladium is in South Africa, a byproduct, and it's about 40% of global mine supply. And that falling price of the platinum the falling platinum price led to really a decline and almost a complete stoppage of exploration and development in the platinum sector. And my argument has been driven by paper trading, not true supply and demand fundamentals. Right. And the second thing that happened during this prolonged period from 2010 forward was that there had been a substitution starting of palladium for platinum just because of the price differential. I mean, you're talking about, 750 neighborhood for palladium, whereas platinum at that time was, roughly double that, even more than double that. But what we found now is that in the last several years is that the substitution of palladium for platinum has led to development of new generation of catalytic converters. The 85% of palladium consumption is in the catalytic converter side of things for the automobile engines, for gasoline engines. And what we find now is that platinum can't meet the performance standards of palladium. They've designed these new high-performance catalytic converters. And so we've been eating through the above-ground stockpile. And, now we're into a shortage situation where the price has risen really materially. Back to your point, is it's risen really materially, and yet these lease rates are, they spiked to 36% there about a week and a half ago, 2 weeks ago. But they're still holding at 12% right now, even though, there's Nornickel dumped an extra 100,000 ounces, and JP Morgan offloaded, I think, about 40,000 ounces into the London market there last week, pardon me. And, it led to the droppage of the lease rate. I think the 1 month lease rate, which reflects the cost of borrowing the metal, which is, I think, a true market indicator of shortage and availability of the bars. It dropped the lease rate for 1 day down to 4%, and then it spiked right back up again now to the 12% range, and it's holding. Right. So it's very interesting, Chris, to see this, rising prices and yet continual indicators of lack of availability of the metal to market. And I think this is really a consequence of the pricing of these metals with paper in London. Gold, silver, platinum, palladium, all four of them have the same problem, that they're trading these promissory notes, unbacked promissory notes for metal to set the price. And that always leads to, I think, upheaval in the long term.
Yeah, and I believe you mentioned before that it's about a 10 million ounce a year market, and there's something like 20 or 30,000 ounces that are actually available. Is those numbers correct? And could you put that in perspective?
Yeah, it's about 30,000 ounces available in New York of that order. That's the combination of the registered and the other category that's there. So, I mean, the registered is what's available to the market. And, that's, see, the difficulty with the New York market, Chris, is that there's so little metal that it's purely a digital market.
Right.
And when people actually say, well, we'll take delivery, we'd like to have delivery now, typically they get these exchanged for physical contracts, EFPs. And what those are is really a deflection from New York into the London market. But again, the problem is it's not actually bar that you're getting. You're getting a futures contract.
Right.
And these futures contract in London are themselves unallocated. So you've gone from paper to paper.
Yep. And
what they're really trying to do is just kind of niggle out a little bit of time to try and source the metal that you need. But, when you look at these registered and eligible contracts in London, it's laughable. In round numbers, call it a 10 million ounce a year market for palladium. And there's Scotia is estimating about a 1.5 million ounce deficit this year. Yep. And so, Norilsk stepping in last week with 100,000 ounces is that's rounding error for the market. It's not going to change things. And I think on top of that, we've got this structural problem with platinum and palladium, but we also now have this dynamic of loose monetary policy. And when you have that QE starting up everywhere, globally, you see all the central banks and the markets, I think, have wised up to the fact that diluting currency isn't going to solve our problems. You get a run on the entire complex. So platinum and palladium are the ones that I think are the tightest, but ultimately silver and gold will go as well. And I think silver is the one that is the most concerning to the central bankers, to the purveyors of our debt-backed fiat currency, because they rely on people holding this stuff and utilizing it for exchange. And I think what's going to happen, I believe is going to happen, is that individuals are going to remonetize silver. And it's not going to be an official thing that happens. It's not going to be a remonetization by governments, but that when we have this economic upset coming from this endless bubble that's been created by our central planners, that there's going to be a loss of trust, number one, and number two is a rush to real assets. And I think that's going to be a driver going forward.
Well, that makes a lot of sense. And I did hear on your interview on SGT Report, you had some interesting silver comments, which my silver addiction. And we'll come back to those. Although something else you just touched on, are we, and you and I have talked about this in recent weeks, are we at the break point where I think a lot of people are expecting everything that you've said and talked about, with some point in these metals? Are we there? Is there, or perhaps put another way, is there any other possible outcome at this point?
If you have total economic collapse, it ends up, the lights aren't turned out in the world, right? Life goes on ultimately. So you could have a total collapse in demand for things that for a period, could give markets this. Markets typically run to treasuries, right? It's crazy. But so you could have a spike down in prices, in the digital prices. But I think that the issue is that central bankers, they've got one tool, and it's the hammer, and the hammer is basically liquidity. Mark Faber calls them the money printers, and that's what they are. So they're like, I've got this problem. Oh, you need more money. Okay, we've got this problem. Oh, you need more money, right? So they forever have the same solution, is that they've got one lever, and all the problems look like they need them to pull the lever. So, a major global economic upset still is going to lead to QE and a run into real assets. So I think that what we do see, though, is that it's not going to be a big bang in terms of the failure of rigging markets. And my thesis has been that it's going to be a sequential failure. And, I started talking to Jay Taylor about this back. We were doing interviews on the markets. And the way I came at this whole situation was that observing that they're trading unallocated, unbacked paper contracts in London and New York. And London really is the critical market. It's the global physical bullion market. And, recognizing that they're mispricing precious metals, it's okay. Well, these guys are using paper, and as a consequence, they're going to not reflect true supply and demand balance. And as a consequence of the mispricing, we're going to have shortage. This stuff's going to disappear. So the discussion back then in 2015 with Jay was, okay, it looks like palladium is the one. That is the one where it's the shortest supply of this actual physical metal to market. And let's watch that closely. And then we started to see the lease rates popping, starting a couple of years ago. And then here we are. And I think if you go to like the second last chart that I sent you in that email, or the third last one, sorry, Chris, you can see the palladium market here, the commercials. And this was the chart by David Brady of Sprott. And the blue bars, the vertical bars there, they represent the commercials. So that's the banks and the users. And these are net short positions. So they've historically been able to short the metal and drive down the price. So when you're shorting metal, you're selling metal into the market, essentially selling positions into the market until you overwhelm the buyers and you collapse the price, and you hit the stop losses of the traders, and you blow them out of their market, and then you reset the price again, right? So historically, that's been the tool. And what we can see in that chart from David Brady is that December 2018 was the initial start of the retreat of the commercials from shorting this, relentlessly shorting palladium in the market and driving down the price. And you see that yellow line arrow down, right? You can see this pullback, and basically the price of palladium appears to have gone almost asymptotic in this graph. But there's been a bit of a pullback recently. But you always pause on the way up in these markets. But it looks like the failure of paper pricing in palladium market is there. And then if you can go to I think I sent you a graph there in Twitter. And that's the prices and positions in the palladium market. Okay, so if we look at that graph there, what that upper, and I'm sorry that it's not clear, it's just a consequence of the graphic that I was able to download. But this chart runs from about 2008 forward. Now, the upper line there with the red arrows pointing down, what they're showing is that just after those vertical green lines, those are where the net shorts and the shorts by the commercials. So again, that's selling of futures contracts into the market. And what you can see here is that those red circles are showing when they hit a peak in the temporal sense. In 2013, 2017, and 2018, they maxed out. In a short-term basis, their short positions in the market. The commercials did. So again, the banks and the users. And guess what? The banks and the users do not like to see high metal prices, right? Because from the bank's perspective and from the economics perspective, spiking precious metals are a warning of loose monetary policy and thus higher interest rates. And then, as a follow through to that, if you can't run loose interest rates anymore, it stops the bubble, the debt bubble and the speculative bubble in the financial sector. So you can see each of those three events there, 2013, that's 2016, and then 2018, that the commercial positions, and this is platinum, they maxed out, and they were able to lower the price in each one of those sequences thereafter. You can see it in the upper curve, the light gray dot plot there. And what's interesting now is, can you just jump, Chris, to the other graph that I sent you there in Twitter? This is a graph by Chris Vermeulen that he put in an article. And what we can see here is this is a 12-year trend now that the platinum price has taken out the 12-year trend line, and it's starting to go up again. And we're in about 975 today or something of that order, 960. But we can see that the trend line has been taken out in the 12-year steady decline of the platinum priced over time. It's starting to creep up again. And now if we go back to that previous graphic that we were looking at once again. Yeah, so this graph shows us now, if we look to the very right side, that these are the commercial short positions that we're seeing. And the final red circle to the right there, and this is in the 2020 timeframe. Now we've got a record short position in the platinum market, and to give you a sense, the short position in the COMEX is equivalent to 60% of the global annual mine production of platinum by the mines. So they've got a very, very large short position, and you can see despite this large short position relative to the prior shorts that they've put in place, that you can see that green arrow pointing up, and that's showing you that the price is creeping up still. And they have not to date been able to cascade the longs out of this market. And then let's just take a look at that lease rate chart that I sent you, Chris. But you can see in that the lease rate chart for platinum from today, that we've got a spike up now in the lease rate in London, and that's really interesting. That's a very interesting indicator that we're seeing.
Yeah, and a question I have for you there, David. It seems, as you pointed out, that they backed off shorting palladium, yet have just doubled down. Maybe that's not tripled, quadrupled, some multiple down in platinum. Why do you think that is?
Well, it's just price containment, right? It's just you want to contain the price of the precious metals. Historically, when investors have run into precious metals, they've departed from bonds, and we saw that in 1980, where the interest rates they had to raise them to 19%, right? 9% above the inflation rate at the time, to pull investors out of gold back into bonds again. That's the historic issue. So you can't blow a debt bubble. You can't run a financial bubble with precious metals advertising loose monetary policy. And the other part of this is users like low prices. So why not just short the brains out of it to cascade the longs out of their positions? But this lease chart here from platinum from today, this is today that this spike happened in London. As you can see that the 3-month lease rate there on platinum has jumped to a level not seen since 2010. And the 6-month, which is not shown on this chart, has jumped as well in sympathy. So what we're seeing here is that all of a sudden, record paper shorts in New York, as we saw in that prior chart, and now we're starting to see, we've got a problem with the bar market in London. They're not quite as flush as they were maintaining. And what's interesting is that London, not Switzerland, has now become the primary repository for the world's platinum and palladium stockpiles. So they are now located in London in the vaults. And if you've got a shortage in London, it means you've got a liquidity problem, a global liquidity problem with platinum and palladium. Yep. And so it's quite extraordinary that we were talking today, Chris, and that we had this lease rate jump. So we'll follow it in the days going forward. But I'm expecting that someone has taken delivery in this market, and it's been enough to lift the veil that I think now these commercial shorts that we looked at previously in New York are in serious trouble. So again, I'm looking at all of this in terms of a broad context. And if we look at the very last chart that I sent you now, that email, Chris, of all 4 metals, and this is from Gold Charts or Us, but it's showing platinum, palladium, gold, and silver going back to 1970. Those 4 precious metals, they run as a complex. And what we're seeing now, palladium has basically shaken off the shackles of the paper pricing market, and the commercials have exited that market in terms of being able to short it to a lower price. There's no more shorting happening as the price rises. And now I think we've seen just the first tremor here of today with this spike in the lease rates. It's advertising that behind this low historic price relative to the last, let's say, 12, 13 years, and we've now got a signal that there's actual bar shortage showing up. So I think this is a kind of the first signal, the first indicator that there's going to be problems now in the platinum market next. As this market shakes off paper going forward, I think we're going to see a replication of the palladium chart. And then ultimately, silver and gold, in terms of dollar value of stock, above ground stocks, they will follow as well. But the primary driver for this is not industrial demand. I think what we've seen here is marginal demand driven by QE, by the central banks. And I think this relight that we had starting last fall in September with the Fed stepping in because of the repo market, but both stepping into the repo market and then buying bonds again, we're starting now to see a response from the precious metal sector that I think will be really well and truly accelerated. And big picture wise, when you look at the amount of capital out there versus the value of these precious metals, you can have an absolutely enormous move in the demand for precious metals with a very, very small amount of capital entering these markets. Even if you look at the global global consumption of platinum and palladium, and using the number 10 million for annual demand, I mean, you're talking about $20 billion in round numbers for palladium, or $25 billion, and about $10 billion a year for platinum, global platinum consumption. So what do you add to that at the margins to send this stuff into another dimension? Is you can see, it's not very much.
Yeah, and I found it was interesting. Sean from SGT Report, he asked you what you thought the price of silver would be simply if the short paper wasn't there. And I thought that put in, I'll let you answer that, because I thought it put into perspective the magnitude of what this is leading to.
Yeah, I mean, it was a question on the spot, and I answered intuitively, not entirely intuitively, but just with a sense of the amount of money supply that we've seen increased. And I mean, if you want to give it a figure, we can roll back and we can look at, what happened historically with the money stock in the U.S. Versus the price of metal. And if we look back now to 1914 was the first year of the Fed's operation. Gold was $19.25 an ounce at the time. And the total amount of outstanding, we'll call it M2 money stock. I mean, it's not my preferred measure, but it's the one that's available to that date. But there was about 16.48 billion of total money issued. And at the time it was money because it was backed by gold, or it was gold itself. I shouldn't really say backed by gold, because the notes at the time were redeemable. And today, so we've gone from 16.4 billion to 15.5 trillion, or from 16 billion to 15,500 billion. So that's a jump of about 950 times. I'm reminded of Bill Sapphire used to have a quote, which an acronym, which was MEGO, and it's my eyes glaze over. And it is. It's the numbers are so large that people just think, wow, those are astronomical numbers. Can't be real, or whatever. Let's go back to the football game. So, but you've had a 950 time increase in the amount of, let's call it, currency in circulation. And if you took that $19 price of gold, it would be worth roughly 950 times more. So, about $18,000 an ounce if you wanted to scale it that way. And so, you can do the same exercise with silver, but I mean, you're looking at astronomical jumps in the price of these metals. So I think 200 is a very low number in terms of where these are going. And I do believe they're going to be remonetized globally, not in any one country, but globally. And the remonetization, I don't think, is necessarily going to be official. And that you're going to have the mass movement towards back towards these media of exchange, which the monetary metals, gold and silver, are in particular.
Yeah, it's certainly fascinating. I think a lot of us in the metals community have been expecting this, and it seems like we're finally seeing it happen. A few last ones before we let you run. One thing I've been thinking about is how for years we had this pattern in many of the metals where banks get long or flat, price is about to go up. Then when they get short, you can expect the hammer to drop.
Yep.
It's pretty much held until last summer, which was something I was fascinated by, where we saw the banks get short as that rally that began towards the end of May and carried through June, July, and August. And we were expecting the hammer to drop, which there have been moves up and down, certainly, but not really. We haven't seen silver go back to $15 or anything like that. I'm wondering, is it World War III going on beneath the surface there, and really just all these things you've described for the last half hour bubbling up? Is that your take?
Yeah, I mean, I think there's behind the curtain, and the London market in particular is heavily veiled, and there's a reason for that, because you're supposed to follow the unallocated digital price and not supply and demand. That's the entire purpose of that market that was created by the Bank of England, and they facilitated the creation of these markets back in 1987. And there was intense lobbying by Evelyn Rothschild, who was running the gold, running the gold side of things for the Rothschilds. He was intensely lobbying Margaret Thatcher for the creation of the LBMA. It wasn't just the Bank of England. So, you have these paper markets were created since then, and that's been the story. That's the narrative that you're supposed to follow. But the real supply and demand dynamic, which is the market, has been basically stepwise. You'll notice that 10 years ago you used to be able to get lease rates. It used to be posted in a number of different places, and now you've got to contact bullion banks to get these rates, and they're not posted typically on the internet. And that's the critical measure. It tells a different story than what is told by the price. And so I think that I do think that there's intense activity, and I think that platinum now is the veil was lifted today in terms of, whoa, look at that jump in that lease rate. Now let's see if it follows through, if it falls down, or if it continues to follow through. But marginal demand. And by the way, I have a friend who works in the fuel cell industry, and he says that the major auto producers that he's in contact with have indicated to him that they understand that the battery-driven electric vehicles are not a path forward because of their limited range. And in particular, really poor operation in the wintertime, and they do not give you the performance required to operate here in North America. And that they are moving towards hydrogen-powered fuel cells, and there's a platinum driver in terms of the catalysts in these PEM membrane fuel cells that are utilized nowadays. So you're going to see a new driver come into this market. But I think that the way forward is hybrids, and hybrids have a very intense usage of palladium in their catalytic converters. And combined with fuel cell vehicles, there's a very poor network of hydrogen fill stations that are out there right now, but that's going to change with time. But I think that's the path forward. And I think that, essentially that electric vehicles driven by batteries are going to become kind of urban scooters for short range things, but that they don't really have the capacity or the performance needed for pickup trucks and for longer range cold weather operation in North America for sure.
Yeah, it's going to be stunning to see how this unfolds. I wonder if it's just bankers that probably, like you said, all they know is how to short things. And I mean, you'd have to think they know it's blowing up, but maybe it's that mentality that I remember from my time on Wall Street where, well, as long as you get your bonus next year and it blows up on someone else's watch.
Fair enough. Yeah. But you see the commercials, I don't think the commercials saw the QE bus, right? They just thought that they just could continue shorting this stuff. And all of a sudden, boom, I think the QE bus has shown up in platinum. And the QE bus, what I'm referring to, is quantitative easing driving marginal investment demand for things that you can't print. And I think it's of the order of probably maybe 5% additional demand to start with. And it's like these markets are maintained behind the paper veil, the digital veil of unallocated trading. And all of a sudden, oh, can we take some bars? And I mean, we know that's happening out there. We know that Munich Reinsurance, Munich Re, which is like one of the largest insurance companies in Europe, in 2016, they were palletizing euros and gold bullion and storing it in their vaults when they first started seeing negative rates in Germany. So we know that that's happening, and insurance companies are forced to do these types of investments with the low rates because they're on the glide slope to insolvency when you start seeing negative rates for an insurance company. They can't tolerate it, right? They've got to have the capital there for the insured when it's needed. And if you're eating up your principal, you're out of business. So it's, I think that what we're seeing is just a few percent marginal demand has hit this market. And then today, platinum popped, and it's going to be very interesting to follow going forward, Chris.
Well, I'll say if we do have any bankers watching today, you can go ahead and hit that subscribe button. So when David's on here explaining entry-level Austrian economics, you don't have to be caught off guard like that.
It's too late. It's too late for them. Right? They're short, and it appears to me that they're stuck.
Well, that's why they should have been following you a couple of years ago.
Yeah.
Although perhaps last one along those lines that I'd love to hear your comment on. I often think in terms of, all right, what are the final warning signs? Like if you're working at Enron, what would you have noticed the week before it collapsed? We have more margin hikes last week. And as you've mentioned, I forget what his first name, but Metcalf, and you can remind me which actual organization he's from, but warning people to be careful in the market, which kind of reminds me of one of those times when a politician, comes out to calm the market, and that's when you know something's really about to bust.
Yeah, well, it was the chap there from the LPPM, the London Platinum Palladium market. And the Financial Times printed his letter, what was it, about a week and a half ago, right? But he was pleading with the other banks to it's almost like think of the children type of pleading letter. It was crazy. He was saying they should consider the tremendous distress that the market had seen back in the late 90s when they had the prior paper blow up that the Russians essentially saved them from their own devices. with their massive palladium stockpiles. But he was basically pleading with the bullion banks to consider what happened the last time when they're pricing their metal, right? Which is really cryptically, my reading of it is really it's a cryptically begging them not to price the metal too high and drive this too crazy, right? Because these bullion banks are going to show their short positions in the market on their balance sheets, and they mark to market these paper losses. And if you drive the price bananas, you can start popping the bullion banks, which I don't think would be a bad thing to clear some of these price riggers out of the market. So think of the children.
Well, you got my vote, and in the same way that back in 2007, 2008, Hank Paulson, Ben Bernanke saying subprime was contained, and in the same way we see Metcalf saying, please be nice to my market.
Yes.
I think folks would be well served to heed your advice, and you really laid it out clearly, David. As you've been doing on Twitter primarily, I know you're also running a company, so I think a lot of us speak for myself, although I know there's a lot of others that are really grateful for the information you share. And perhaps just in closing, I'll mention your Twitter handle is @RealDavidJensen. That's JENSEN. And David, if there's anything else that you'd like to share or have people be aware of, by all means, please let us know.
Yeah, no, that's fine. If people want to get in touch with me, they can DM me through Twitter. Other than that, yeah, thanks for your time. And it's as a student of the markets, it's really an incredible thing to observe, basically sequential failure of rigged markets. And we have enough information, Chris, that I think that we've got a front row seat on this. So Palladium is gone. I think Platinum told us something today. We were waiting for it. And it's going to be very interesting watching it going forward, because these markets are going back to supply-demand pricing. One way or another, they're doing that. And this is the end of a really historic era. So it's really interesting to watch.
Yeah, I think you summed that up well. And again, I'd personally like to congratulate you. I know you're humble and not perhaps going to say it, but it is a fascinating time, and you've really been ahead of the curve. So it's a pleasure to have you on the show, and I'm sure we'll have some fun conversations going forward.
We will. Very kind of you to say that, Chris. I appreciate that. And I do look forward to tracking it going forward along with you.
Well, it's going to be fun, and I'll be looking forward to that.
Sounds good.
So that is today's episode. I do thank you for spending some time with me and hope you enjoyed it. If so, go ahead and hit that subscribe button, and I'll see you again soon.